Good day and welcome to CreditAccess Grameen Q1FY24 earnings conference call hosted by Equirus Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shripal Doshi. Thank you, and over to you, sir.
Thank you, Seema. Good evening, everybody. I welcome you all to the earnings conference call of CreditAccess Grameen to discuss the Q1FY24 performance of the company, industry trends, and business updates. We have the management team of CreditAccess Grameen with us, represented by Mr. Udaya Kumar Hedar, who is the Managing Director and CEO, Mr. Ganesh Narayan, CEO and Chief Business Officer, Mr. Balkrishna Kamath, CFO, and Mr. Nilesh Dalvi, who is Head of Investor Relations. I would now like to hand over the call to Udaya sir for his opening comments, after which we can open the floor for question and answer. Over to you, sir.
Thank you, Shripal. Good evening to everyone. We thank you all for joining this conference call to discuss our first quarter FY24 financial performance. Before we commence the discussion on Q1 FY24 results, I take pride in informing you all that we have entered the 25th year of our operations, playing an instrumental role in expanding financial inclusion across the length and breadth of our country. Our strong fundamentals, work ethics, customer-centric business model, and employee-centric operating model have helped us to remain socially relevant and become the preferred financial partner to a large number of low-income households across rural India. While our aim is to soon surpass rupees 25,000 crore loan portfolio during the 25th year of our operations, the next 4-5 years plan is to see us doubling our loan portfolio to over 50,000 crores by leveraging our solid foundation and leadership position in the microfinance industry. Talking briefly about the first quarter, we witnessed strong business momentum led by growth in our customer base. We added 3.28 lakh customers, of which 47% came from outside of the top 3 states. Our customer base grew 19.9% YOY and 3.7% QOQ to rupees 44.2 lakhs. Our AUM grew 39.7% YOY and 3.7% QOQ to rupees 21,814 crores, while the disbursement grew by 122.3% YOY to rupees 4,721 crores. Our footprint expanded with 40 new branches, taking the total branch network to 1,826 branches across 353 districts. Our interest income grew by 50.1% YOY and 14.6% QOQ, largely driven by robust loan portfolio growth in the fourth quarter and the benefit of loan repricing over the past 12 months. Our average and marginal cost of borrowing for Q1 FY24 stood at 9.6% and 9.1% respectively. Since our cost of borrowing largely remained stable during the quarter, our NIM expanded to 13%. However, we expect some increase in the cost of borrowing over the coming quarters as we work towards increasing the share of long-term borrowings. The $100 million drawdown under the social loan facility happened in the last week of June. Hence, it did not impact the cost of borrowing in the first quarter. We should see its impact in the second quarter. Further, we shall complete the drawdown of the remaining 100 million under the social loan facility in the second quarter. Also, we have to work towards raising the second tranche of public NCD before November 22. These drawdowns will result in 20 to 40 bps increase in our cost of borrowing for the coming 2 quarters. However, on the lending side, we should also cognizant of the fact that 16% of our loan portfolio, which is pre-April 22 originated, is yet to be replaced and should provide some cushion against the rise in the average cost of borrowing. Hence, as of now, we reached our guidance of 12 to 12.2% NIM for the financial year. Our maiden $200 million syndicated loan facility marked the first such transaction in the NBFC MFI industry and fourth in the country. This has helped us to broaden our lender base to over 70 lenders with many banks from Taiwan and Middle East taking major exposure to the Indian microfinance industry through this transaction. This also resulted in increasing our share of foreign borrowings to 19% at the end of June 23 compared to 14% in the last quarter. Our liability strategy, which is most essential for keeping the growth engine well in place, playing out really well, with 39% of our total drawdowns in Q1 FY24 coming from foreign sources and undrawn sanctions in hand also having 27% from foreign sources. This will further diversify our liability profile, increase the share of long-term and stable funds, and enhance the positive ALM mismatch as per our plans. We continue to pursue our plan on liability diversification as we grow larger. Our operating profitability significantly improved in the first quarter, with the net interest income growing by 65.4% YOY to rupees 763 crore, and the cost-to-income ratio declining from 39.7% in Q1 FY23 to 30.8%. We expect cost-to-income ratio to moderately increase in the coming quarters and shall remain within the guided range as we invest in the branch expansion, technology initiatives, and additional measures for building manpower for growth and controls in the coming quarters. PPOP grew at a healthy pace of 87.7% YOY to rupees 544 crore. The credit cost in Q1 FY24 stood at 76 crore, including rupees 7.8 crore management overlay on the legacy book of MFL, which was only rupees 72 crore or 0.3% of the total loan portfolio. The credit cost was partially offset by rupees 12 crore of bad debt recovery, resulting in net credit cost of 0.3% in Q1 FY24. Our collection efficiency, excluding arrears, stood at 98.7% at the end of the first quarter. GNPA measured at 60 plus DPD reduced further to 0.89% at the end of June 23 compared to 1.21% in the last quarter, while net NPA stood at only 0.27%, signifying the best-in-class of asset quality. Our PAR 90 plus stood at only 0.7%. PAT grew 151.5% YOY and 17.5% QOQ to rupees 348 crore during Q1 FY24, marking the highest ever profitability in the first quarter. This resulted in ROA of 5.8% and ROE of 26.4%. The capital adequacy ratio remained comfortable at 24.4% at the end of Q1 FY24. The strong outperformance during Q1 FY24 versus our guidance was primarily due to robust customer and portfolio growth. While we do anticipate borrowing and operating costs to moderately increase for coming quarters, we believe that the benefit of strong portfolio growth in the first quarter will continue to accrue from higher interest income over coming quarters. Hence, we shall continue to monitor our performance and reevaluate our annual guidance after 2 quarters. Before I hand over the forum for question and answer session, I would like to quickly touch upon the successful promoter stake sale comprising 90 lakh shares or 5.7% share, which was consummated on 30th June 2023. As informed earlier in our various communications, this transaction has helped us to further expand our shareholder base and increase the free float in our stock. Post this transaction and the issuance of shares to MFL shareholders as per the share swap arrangement post-merger, the promoters holding now stands at 66.77% as on June 30, 2023. The institutional investor holding has increased from 21.95% in March 23 to 27.12% in June 2023. The transaction received strong interest from both existing as well as new investors. As indicated earlier, this measure was facilitated by our promoter for broadening our shareholding base as well as the free float, and we have largely achieved our objective quite successfully. The patient capital from CreditAccess India BV and their firm support will continue to help us channel our energies towards fulfilling the growing business potential as presented during our Analysts Day on May 18, 2023, and most of you joined in this conference. Lastly, I would like to congratulate Ganesh Narayanan for being elevated as Chief Executive Officer effective from 1st August 2023, subject to shareholders' approval. in the upcoming AGM. Consequently, I shall continue to lead as Managing Director. Thank you for your patient listening. We may now open the forum for the question and answer session. Thank you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Mr. Nikhil Rumta, Nippon India Mutual Fund. Please go ahead, sir.
Yeah, hi, sir. Thanks for the opportunity. First of all, congratulations on great set of numbers, and also congratulations to the new MD, Mr. Ganesh. Sir, just a couple of questions from my side. To start with, first of all, this is one of those seasonal quarters wherein we see the weakest quarter for our company in general on an annualized basis. But this time we have gone against the trend. So do you see this as structural, that all the 4 quarters would remain as a strong quarters, or is it just one-off in terms of seasonal nature?
First, I want to correct you that Ganesh elevated as Chief Executive Officer, and I'll continue to be remaining as Managing Director.
Sure.
That is correct. Maybe that's a confusion. Okay. So I think, it's supposed to be a good quarter even last year, but we took a decision to implement regulatory changes. Otherwise, from July onwards, we grown well. Last year also, if you remember, Q2 last year, we did extraordinarily well, and we are continuously doing well. But in any case, in the first half, normally in this business, performance is about 40% of the annual growth. So 60% normally goes to second quarter. So our sense is that it will be a continuous strong performance going forward, because we have built everything, every pillar of the organization is in place, every pillar of hygiene is in place. Therefore, we believe we will be able to perform quite well in all quarters.
Okay. And since we have grown at 40% in terms of AUM, but you have maintained your guidance of 24 to 25%, do you think there is a significant upside risk to our guidance, both in terms of AUM growth or margins or ROA or ROE, anything? I mean, because if I compare or collate this with my first question, then 1Q being the weakest quarter for the year, the guidance should have upside risk. So do you believe that could be a possibility?
So actually, as I said in the initial remarks, so the customer acquisition improvement as well as disbursement picked up, which has contributed for the better performance this quarter, and that benefit will keep accruing for the entire year. But still, we would review after Q2 or Q3 to reevaluate our guidance.
Okay. And so last question from my side, how much yield repricing is still pending in our AUM as of now? I believe you touched upon this in your opening remarks, but things were not clear. So just wanted to clarify on that part.
Yeah. About 16% of the portfolio yet to be repriced. Therefore, that's what exactly we said. Though there is a potential increase in cost of borrowing, but there is a repricing also there for about 16% portfolio, so which should take care of that cushion. So some cushion is available, but yeah, there will be still we need to watch for next 2 quarters to evaluate our overall guidance.
Perfect. Sir, that's all from my side. Thank you so much, and congratulations again to you and your team for taking care of all the stakeholders. Thank you.
Thank you.
Thank you. We take the next question from the line of Mr. Sumit Rathi, Centrum PMS. Please go ahead, sir.
Thank you for giving me the opportunity, and congratulations on the great set of numbers, sir. So my first question is, on the qualitative side, how are we seeing Bihar and Uttar Pradesh as geographies and the other newly added geographies where we are adding on our branches incrementally? How have we been experiencing things so far, sir?
So our experience in all the states, particularly Bihar, UP, Orissa, Jharkhand, all are quite good, and we are not seeing any any weak or difficulty in any geography there. All are performing very, very well.
Great. Another thing, sir, on our GLP per branch is around 12 crore and our GLP per loan officer is around 1.8 CR. So where do you see in a steady state business the saturation point to come, which makes you to decide to open a new branch or add an incremental employee? And also, if you can add, a branch covers what kind of catchment area on a steady state for us?
So, branch when we start over a period of time, it grows. So what we decided is once branch when crosses about 7,000 customers, so we actually do one more branch and shift the portfolio to the other branch so that both can go together. So the load management we manage in such a way. Whereas loan officer is an outcome of how many customers he handles, and the number of centers what he's handling is the outcome of how many customers he handles actually. So therefore, we limit the loan officer to handle not more than 5 to 6 centers so that he can manage the relationship well rather than just dispersing money. So which actually how if the number of centers are 5 to 6, the maximum portfolio he may handle between 1.8 to 2.2 crore depends on the geography and depend on the vintage of the customers as well.
Great, sir. Sir, on our new types of loans which we have come up and envisaged the idea about that in our recent meet also, how are we seeing the progress over there? Or the ground level
progress. Yeah, it's a quite good pilot. We actually publicized that 2 of the pilots are will continue and 3 of them will start scaling up, particularly individual business loans, the individual LAP and LAP as well as the two-wheeler will scale up, and gold loan will continue to be pilot to be able to test more, whereas affordable homes we had to start the pilot this year. So all are giving a very good result so far. So, but we are continuing to scale it up and then test more. I think at this point of time it is only about 1% of the business. So as we grow, we'll start publishing the number also.
That's great. And one last question on cost to income ratio. This quarter would have been probably one of the best quarters at 30%. So how do we envisage this on a steady state basis? Is it like 34 to 35, or it can be below 34 and slightly up 30? Where do you see it going, given that great momentum and business pickup has been observed?
So what we graded is 34 and 35%, 34 to 35%. That's we reevaluate. Right now we are reconfirming our ability to meet the guidance, and maybe after next 1 or 2 quarters we will reevaluate and come back if there's a change in our guidance in all the 4 parameters what we guided to you.
All right, sir. Thank you for patiently answering. I'll go back into the queue. Thanks, sir.
Thank you so much.
Thank you.
Thank you so much.
Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your question to 2 per participant. We take the next question from the line of Mr. Renish from ICICI. Please go ahead, sir.
Yeah, hi sir. Congrats on a great set of numbers and congrats to Ganesh for a new role. Sir, just 2 questions again. Sorry to circling back to the cost part. So if you look at this quarter, there is no one-off income and at the same time there is no one-off expense as well. So, I mean, is it fair to assume that this 31% cost to income is the new normal, given maybe we are now actually benefiting out of the scale and we might not get back to those 34-35% cost to income? I mean, what is your internal assessment on this, sir?
Difficult to assume with one quarter change, Ramesh. So that's why we said that we will watch for one or two more quarters to review and come back, because as I explained in the initial remarks that there are certain costs might come in the Q2 as we grow. We have to open more branches. We are actually adding more manpower for control and growth. So there are some costs will become upfront, right? So therefore, it's difficult to assume right now. So we need to watch for stable one more quarter to review on this.
Okay, but let's say we are not going back to, let's say, those 38-40% cost to income which we used to have, let's say, in FY 18-19.
But in any case, we have guided that 34-35, right? That we are assuring that we will be able to reach there. So right, if it is more, if improving there, probably we'll come back after some time.
Got it, sir. And so my second question is slightly at the maybe industry level or slightly a longer term. So let's say since FY23, the sector or industry has been going through one of the best cycle and has been growing almost 20-25% in industry level. Of course, good players like you are growing a bit faster. But historically, we have seen, whenever industry has seen this kind of a growth for 2-3 years, there is a tendency of any state or any pocket, sort of derail the momentum. So internally, sir, what kind of early warning signal you guys track to preempt the business cycle? It could be, let's say, center attendance or anything.
I think in the analyst meet we have definitely clearly told about how our control systems and how our risk management is ably controlling the growth as well as the credits actually. So we have put a strong monitoring system, multiple defense system. I think 3 defense system we mentioned about our while before acquiring client and then after lending to them. So I think these are all very, very important. And top of that, creating the loyalty, high touch. So all these are very, very important to work in the bad time. Even if something goes wrong, thanks to I don't think it is only for microfinance. For any industry, you can find some time of blip sometime. But keeping the customer in touch, keeping the employee high motivated, and try to enhance our ability to get the data in terms of the risks, having the dashboard, having the monitoring system, using the as much system and data and analytics. All these are, we keep improving it. I think at least based on the past history, we are able to perform better in all such events what you described. So I think you can hope that we will be definitely doing better even in future if the circumstances comes in front of us.
Got it, sir. And this is just the last data keeping question. So of the total customer base, sir, what percentage of customer base will have a more than 1 lakh rupees outstanding at the industry level?
Industry level, I don't think we have data as of today. I think as of March, around 7.5 or 8% as of March, I believe. I don't have right now answer with me. Maybe Neeraj will take to gather from micrometer and let you know offline.
Sorry. Let me rephrase it. Let's say what percentage of our customer base will have total outstanding of 1 lakh, including other lenders?
So, right now in front of me more than 50,000 about 43%, but average is about 63,000 for the customers with date more than 6 years. So only those guys will be able to get more than 1 lakh.
1 lakh.
But average is about 63,000. And in our case, there's something different you need to look at. So as we explained earlier also, any customer with vintage more than 4 years have a very less risk in our case. We even price them 1% lower than others. So in any customer, if you have more than 1 lakh, it's always more than 4 years with us. So that kind of profile we have, the vintage profile, which have a very, very big deterrent for us, in terms of the credit risk actually. So lesser credit risk.
Got it, sir. Got it. This is very helpful, sir. Thank you and best of luck, sir.
Thank you. Thank you so much.
Thank you. We take the next question from the line of Ms. Shweta Dadar, Elara Capital. Please go ahead.
Thank you, sir, for the opportunity and congratulations on great set of numbers. So, a couple of questions. One is, if you look at the current quarter, then there is marginal drop in the IGL loans and sad rise in home improvement and retail finance loans. And also, if you look at the industry level, the individual loans have been on the rise. So, how do you perceive this from the risk parameter matrix going forward?
No, I think it is not a big number because overall number in the non-microfinance is just 1% or less actually. It may be very small variation you will see. So I don't think it's any significant we cannot make out anything out of that right now because of the so small portfolio in the non-microfinance book. So it's growing book.
Okay, I'll rephrase it in a different manner. So we have also alluded to the fact that individual loans will be slightly increasing in the portfolio. So whether these individual loans are largely cross-sold or graduated from the existing customers, or these will be coming from the newer portfolios and new to credit customer base?
Yeah, Ganesh. Okay. So these individual unsecured loans, as we had guided earlier, even in the medium term, should hover in the range of 5 to 7% of our portfolio. And these are pre-selected graduated customers with certain credit behavior with us and certain vintage and certain type of profile that is chosen after assessment. So that is definitely a graduated book, and we believe this would also behave well as we move forward.
Yeah, for your question about is there a new customer, it's completely existing retained customer, Shweta.
Okay. Noted, sir. So, second question, if I look at the borrower mix, so clearly the borrower share from the home turf markets and the markets where we have key presence, is continuously falling. So, what is the kind of growth that we are seeing in these top 4 states of Karnataka, Maharashtra, TN and MP, and what would that be in comparison with other few markets which are growing for you? So is Karnataka or Maharashtra growth now in single digits, and how are you perceiving penetration and growth in the existing home turf markets?
So based on the base and then the vintage of the Karnataka, Maharashtra, Tamil Nadu, we believe that this growth will be either the single digit or the low double digit growth, whereas overall we already said that we will grow between 24 to 25%, which means northern geography, which is non-core market, will grow faster. So we are witnessing that growth already. That is why that particular data about the new customer, 47% are coming from a different geography than the top states, which is good as a diversification point of view.
Okay, thank you, sir. I'll come back in the queue.
Yeah, thank you.
Thank you. We'll take the next question from the line of Mr. Abhishek from HSBC. Please go ahead, sir.
Yeah, thanks. Hi, Uday and team. Many congratulations for the quarter, and congratulations to Ganesh for the new role as well. So one question, sorry to sort of get back to the yield and cost question. So you said that there's about 16% of the book which is pre-April 22. There would be some more part of the book which would be first half last year, which was also at a lower yield. So cumulatively, how much yield benefit are you looking at from this repricing, and over what period?
See, so 12%, the 16% is pre-April, which was the pre-regulation portfolio. The post-regulation portfolio, there is not much change actually. Basically, after February 23, we have not changed the price at all. So therefore, majority of portfolio will not have too much of repricing actually. Repricing benefit will get only 16%, and the additional will get little insignificant, not very significant.
But Uday, the 1Q23, 2Q23, if I look at your presentation, it gives numbers of 20.3 and 20.8 as a disbursement rate.
So, yes, correct. Correct. I got your point, but this will take a longer time. Because this will not get into immediate repricing actually because of long-term loans. So we are not repricing that unless they are maturing and re-lending, right?
Right.
We will not get the benefit immediately. That's why I'm telling that benefit, that there is not significant for yield point of view. Because it's not repricing based on floating rate. These are all fixed rate, right?
Fixed rate, yeah. So basically,
90% of our loans, 90% of loans are more than 2 years. That's why.
Right. So incrementally, maybe 20-30 basis points is the max we could get out of this on a blended basis.
That also it takes longer time. I think this 15% will not give will give about 25-30 basis. Correct. You're right. So that is what we said. Your cost of borrowing might go up between 20 to 40 basis. So to large extent, there's a cushion of this repricing which would take care.
Got it. And regarding costs, you explained that some drawdown was left and you're borrowing long term. Can you give a little more detail about what exactly will lead to this 20 to 40? Sorry, I couldn't follow in the opening comment.
See, we have announced that we have borrowed almost 39% of our borrowing in Q1 from foreign sources, which have a higher cost compared to domestic borrowing. But whereas the actual borrowing happened only at the end of the quarter. The real impact of that borrowing will come in the Q2. On top of that, we are also estimating to borrow some more international borrowing, which is in pipeline, which is already committed. Plus, we would raise NCD also, so which all will have a higher cost compared to the other borrowing cost. Therefore, this might be impacting about 20 to 40% of the cost of borrowing. Hope I clarified.
Right. And the landed cost of this foreign borrowing would be how much post hedging?
It's between about 9.5 to 10, depends on the country and geography and then type of lender.
Got it.
Some of them actually close to 10 actually.
So if I put these two things together, Udaya, so incrementally maybe 20, 25, 30 bips of yield increase and at the most 20 to 40 bips of cost increase. So broadly your NIM should be stable, maybe plus minus 10, 15 bips. But you're still maintaining a 12 to 12.2 NIM guidance. So don't you think, what is going to bring it down?
You need to look at the 2 more quarter because there is a base effect, there is a capital adequacy effect. There are multiple things we need to see. Therefore, we will not be able to take a decision based on 1 quarter result, Abhishek. That's what we said. We will take a decision after some 1 or 2 quarters based on the actual how it moves in the next 2 quarters, 1 or 2 quarters.
Got it. Thanks. And just second question would be on this retail.
Sorry to interrupt you, sir. May we request you to join the question queue, please?
Okay, sure. Yeah, thanks.
Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants, please limit your question to 2 per participant. We take the next question from the line of Mr. Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yeah, thank you. If my line is clear?
Yes, sir.
Hello? Yeah, thank you so much.
Yeah.
First of all, congratulations to your team on a good quarter. And congratulations, Ganesh sir. Very, very good to see this appointment or this delegation to the CEO role come through. So, I don't have any questions on this quarter, but what I really wanted to understand is, given that we now have state elections coming up later in this calendar year and then next year when we are heading into general elections, obviously that noise around elections, potential of any loan waiver announcements, right, might come into the picture, might kind of be the narrative in the coming quarters. So, will it be wrong to think that given that loan waivers when they were announced in Assam and subsequently, I remember advertorials from the Assam government requesting citizens that if they are capable not to kind of take those or opt for those schemes or take those loan waivers. And given that, the recent announcement that we had from the court in Telangana and Andhra Pradesh, would it then be wrong to assume that at least the magnitude and frequency of such loan waivers from political parties will at least decline going forward, even if we cannot rule out that as a risk going forward?
I think Abhijit, we are on the same page. What you're describing, it's such a good thing. Actually, even in the last, a decade or so, elections never impacted the microfinance significantly anywhere. Yeah, there are even earlier the Madhya Pradesh government or the Karnataka government or Chhattisgarh government announced loan waivers, but the customers by and large know that their loans are not getting waived. And also there's a significant awareness in the political side about the capital creation which microfinance are bringing at the rural, which normally government cannot do themselves directly. So therefore, there's a great support from every side, whether it's administration, there's a finance minister or the regulator or the BFS, and you can see all the sides, there's a lot of support for microfinance. Even they would call us for the suggestions when the finance bill is worked. So the way the government supported while there was COVID, the liquidity, the moratorium, many things they supported to the sector to ensure that the sector should grow, sector to stabilize, and even in the case of COVID, that 2 years is the great ground if the politicians want to create any problem, where we did not see any issues anywhere in the country. So Assam is a different issue which can be discussed separately because it's not the outcome of any election, it's the outcome of many different events over 3 to 4 years, including COVID, CAA protest, student agitation, and the election and the government announcement. There are 3-4 events in the 3-4 years' time dedicated to solve the issue of microfinance. They had to come up with a solution. So which is actually solved. It's a great example of how government and the institutions together can resolve the issue. Actually, So looking at all these things in the last 3-4 years, I think there is a lesser impacts because of the elections or such events. There's a great support from entire system everywhere. So we don't see any, we don't expect any issues in the election years. It's always every 5 years there is a national election. Every year there will be multiple state elections, and we have been dealing with that carefully. So maybe during election period, 1 or 2 months, there may be muted growth because of the regulations around, but for that, we don't see any significant impact because of these elections around.
Thank you, sir. And just one last question here.
May we request you to the question queue?
Thank you, sir.
We take the next question from the line of Mr. Sameer Bhise from JM Financial. Please go ahead, sir.
Yeah, hi. Thanks for the opportunity and congrats on a strong set of numbers. Congrats to Ganesh as well. Just quick question, Uday, on some thoughts on creating management overlay as we continue to navigate the good period in the sector. Some thoughts would be helpful.
So for me, if you look at our way of ECL, there is a huge or a very significant inbuilt overlay. If you say it's not that, because if you look at our GNPA, it's about 0.7%, whereas provision is about 1.59%. At a 90 days basis, which means when you compare to Iraq, right? So there's a huge overlay already there. And again, we recognize the stage 2 at 15-day DPD, which means any event we are already there recognizing the requirement, and at 60 days we recognize as stage 3. So therefore, there's an inbuilt layer And there is no such accounting principle allows us to create additional overlay when there is no specific event around us. So therefore, I think there is sufficient overlays inbuilt, and then we always have a habit of early recognizing the risks, which have been observed. We all observed over the last couple of years. So I think we have sufficient cushion instead of any specific overlay here.
Fair enough. So it's okay to assume that the credit cost run rate could be around the current levels. Is that a fair conclusion?
Excuse me, can you repeat, please, Samir? Sorry.
Is it fair to assume that credit cost run rate would be around current levels?
It should be, because we guided the credit cost between 1.6 to 1.8. If you look at the current range, definitely it's within that range. I think we will be able to meet that guidance.
Great. That's all from my side. Thank you and all the best.
Thank you, Samir.
Thank you, sir. We take the next question from the line of Mr. Nidesh from Investec. Please go ahead, sir.
Thanks for the opportunity. Sir, what are the plans to scale our operations in AP and Telangana, the two states which have opened up? Have we started opening branches there already?
So we would want to watch a bit there in both states, because the administratively we need to see the alignment of the administration again on microfinance, because for at least 10, 11 years or 12 years, the administration was tuned to not to accept the microfinance there. Therefore, we are watching that. Maybe we'll be opening few branches and test it how it works, and then take the expansion later, actually. So we will not be in a hurry to go and start operations in AP and Telangana. We will be watchful there.
Sure, sir. And secondly, how is the asset quality experience in the individual unsecured loans that we are scaling in the group format?
It's absolutely great. So it's within our expectation, and the portfolio is behaving very well.
Sure. And so lastly, given that the operating leverage has been playing out quite beautifully, so any plans to pass on the benefit to customers? The current ROA and ROEs are very good, but any plans to pass it on to customers to give them benefit of the operating leverage?
So if you look at, after February, we have not changed the price at all. Even now, again, for next quarter also, we are not changing the price. So we are returning the same pricing to customers. We are not increasing any price. And already we are the lowest priced microfinance in this segment. And I think we will continue to ensure that so customer gets the best from our side.
Sure. Thank you, sir.
Thank you so much.
Thank you, sir. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 on your touchtone phone. We take the next question from the line of Sagar Shah from Phillip Capital. Please go ahead.
Good evening, sir. Thank you so much for the opportunity, and first of all, congratulations to the entire team for solid set of numbers yet again. So my first question was related to our AUM actually. We had around a sequential growth of around 4%. And actually, I wanted to just wanted to understand that obviously, sorry for relating again, this point was already addressed before. But I wanted to gain more knowledge in depth that sequentially we grew by only 4%, and it was below my estimates actually. So was this just because of the Q1 being a seasonally weak quarter before, or is it now that the competition is actually hurting us? Can you specify a reason for slow growth?
No. I think a sequential growth of disbursement or portfolio growth is on the base of 18% growth we had in the last quarter actually. So it's still good. And I think we need to compare the Q1 with the Q1 of FY23 other than Q4 to Q1 actually. So if you see YOY, the metrics are completely different and positive. We don't see any.
With this YOY, it's a completely agreed, sir, that YOY was if you compare YOY numbers, it was a strong quarter, but last Q1 actually was a different situation and a scenario altogether. When the new regulation came into place, we had to degrow actually for one of the quarters. So my is it safe to assume that in the next 3 quarters we will see a stronger growth than this Q1?
Next 3 quarters maybe, but if you see, compare the last year to this year, you said clearly the Q1 last year was lower because of the regulatory implementation, what we did first 2 months, and the junior analysts started growing. Whereas the growth in the last year maximum came in the Q3 and Q4. So that is more of a higher. Based on a higher base actually, based on against a higher base, the first quarter is showing little lower. I think at this point of time, we believe that we will continue to grow between 24-25%, and we will again review after 1 to 2 quarters and see how this will change. We will let you review
this similar growth will be contributed. Can you throw a number that outside Maharashtra, Karnataka and Tamil Nadu actually, which states actually are you getting traction? Obviously, Madhya Pradesh forms the 4th important state for your portfolio, comprising of almost 8%. But outside of these 3 states, how is the demand, or how are you panning out actually?
So the demand and supply by and large even everywhere, but the higher growth is coming from the new geographies, because the older geographies are on a higher base and the vintage, so the growth is lesser compared to the growth in the newer states like Gujarat, Rajasthan, UP, Bihar, Jharkhand, which gives a higher growth, whereas Karnataka, Maharashtra, Tamil Nadu, MP will give the lower growth.
Okay, sure, sir. Now, my last question is related to the asset quality. You have already stated that credit costs will remain at these levels if they obviously keep the management overlay at these levels. Now, obviously, your asset quality has actually once again improved in Q1, and that has been commendable. Your PAR 0 has come down to almost 0.7. So my one suggestion, or maybe from my end, that why don't we actually create some extra provisions, maybe for any, you can say, although we are holding an ECL provision of 1.59%, but why don't we create some extra contingency or a management overlay provision, so that maybe unforeseen event in the next general elections or anything comes up, we can be at least secured by that. Any incident? Your thoughts on that, sir?
Sagar, I think I have already answered this question earlier. I think we said clearly that we are already indirectly holding the additional layer of management overlay within our ECL system, which I explained already to earlier participant.
Okay, sure. Got it. Thank you so much.
Thank you.
Thank you, sir. We take the next question from the line of Mr. Manoj Oberoi from Yes Securities. Please go ahead, sir.
Yeah, sir. Hi, this is Rajiv. Many congratulations on solid performance, and congratulations to Ganesh also for his elevation as CEO. So, sir, question and clarification I seek is on whether a promoter is looking at paring for the stake in the near term. I'm checking just in the near term. And when would we likely raise capital, since the growth is running ahead of expectations?
I think in my opening remarks, I clearly said about the promoter stake. So, what is the objective, and what is it's already largely achieved what we have requested the promoter on support to increase the investor base and on the increase in the float and all those things. But largely we achieved that objective. So therefore, I think it's all bit clear. And the second part is I think again we said clearly earlier that at least for next 7 to 8 quarters, we don't see any capital raise because you can see there's a healthy capital getting accrued, and then we have sufficient cushion for growth for next 2 years. So there would be we don't estimate any capital raise for next 2 quarters, Rajiv. Sorry, next 2 years.
Got it, sir. Great. Thank you so much and best of luck.
Thank you.
Thank you. Ladies and gentlemen, we request you to limit your questions to 2 per participant. The next question is from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi. Good evening, sir, and congrats on the quarter. Just wanted to get an update on the share of our unique customers. We usually used to have around 40-45%, but with how the industry has grown over the last couple of years, what would that number be today for us?
It is slightly reduced actually because as we grow in the newer geography, as we grow in the existing geography, we were able to target more customers who might be the customer of other MFI, eventually moving us as a unique customer. Therefore, from a 40%, it's actually come down by 5-6% at this point of time. But what we observed is, over 12 months' time, they are coming to us as a completely moving out of other MFIs and coming to us as a full unique customer. So I think as the competition increases, this type of unique customer numbers will keep changing.
Yeah, and how many will have more than one lender? Like you and one more lender, I meant.
About 35%, 32 to 35% more than one lender. And only one lender. Sorry, more than one lender is about 28%. 20%.
Sorry, 20.
20 more than one lender. 20, 29, 30, 34%, sorry.
So 34% of your customers have 3 lenders, including you.
More than one lender is had. So more than 2 lenders, if you want, it is 14%.
Okay. No, so it does not add up.
More than one lender is
So unique Grameen is 34%.
Unique is 34.
Correct.
Again, unique plus 1 is 32.
32,
then
okay.
Unique plus 2 to 20. Then more than 2, 14. Total 100, right?
Yeah. Okay. So unique plus 3 is 14. Okay, got it. More than 30. And so then where are which states have the highest share of unique customers? Like, I'm just trying to think as to where is the white space which is not yet penetrated by microfinance in terms of geography.
Always, our old geography where we have been established for more than many years, particularly Maharashtra, Karnataka, Tamil Nadu. So we always have very high percentage of unique customers.
Okay. Got it. Okay, and thank you and all the very best.
Thank you so much. Kiran.
Thank you. We take the next question from the line of Mr. Ajit Kumar from Nomura. Please go ahead, sir.
Thank you. Congrats for the direct set of numbers. Just few data keeping questions. What would be the average disbursement ticket size in this quarter?
It's about 40 rate disbursement. No. 45,000. 45,000 average disbursement.
Similar to last quarter, right?
Yeah, it's same. If you see outstanding per customer also, when that remains same.
Okay.
In all 3 buckets, below 3 years, 3 to 6, all are by and large remain same only. Does not change.
Okay. Thank you. And just last thing, any comment on borrower leverage, including all lenders, as you would be having data for 4 to 5 quarters now?
So borrower leveraging is, defined by regulator already. It's more of a leveraging, rather than leveraging, more of a FIR, how much they're actually paying, their obligations. Actually, so that's more important. I think we have about 40%. Is less than 40%. That's right. Actually, while we can actually give up to 50% FOIR obligation, we can go up to there. Or 75% of the borrowers have what you call FOIR is less than 40% today.
Okay. Thank you, and congratulations again for great. Thank you.
Thank you so much.
Thank you. Ladies and gentlemen, that was the last question for the day. I would now like to hand the conference over to Mr. Shripal Doshi from Equirus Securities for closing comments.
Thank you, Seema, and thank you to all the participants for being part of the call. We would like to thank the management of CreditAccess Grameen for giving us this opportunity to host the call. Thank you, everybody, and have a good weekend.
Thank you so much, and I'm passing on all our wishes to Ganesh here. So thank you very much, and have a nice day.
I'm also thanking all of you for your wishes. Thank you so much.
Thank you so much.
Thank you, sir.
Thank you. On behalf of Equirus Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
240 people. 240.